runoff from $60 billion a month to $25 billion may have been a little bigger than some people expected. React to that, and what in a practical sense does that mean to the markets and to consumers and the general public?
What happens when the safety net for smaller banks disappears and a mysterious investor steps in? This is what's happening now. Failed banks are being bought by an investor. What's the reason behind it? The Federal Reserve's Bank Term Funding Program served as a pivotal support mechanism for smaller banks, offering loans against high-quality securities during financial stress. Its conclusion on March 11, 2024, has indeed altered the banking landscape, leaving smaller banks more exposed to liquidity challenges in volatile financial periods. The absence of BTFP's safety net could compel these banks to seek alternative funding sources, increasing the risk of bank failures and presenting opportunities for investors to capitalize on such vulnerabilities. If a bank fails, the Federal Deposit Insurance Corporation takes over as the receiver to sell or collect the assets of the failed bank and settle its debts. The FDIC ensures that depositors receive their inspired deposits to the legal limit, which is generally $250,000. The process is usually expedited, with the FDIC identifying healthy banks to submit bids for the failed bank's assets and liabilities. The winning bidder acquires specified assets and assumes specified liabilities from the FDIC instead of acquiring the failed bank entity itself. How will Portico Capital's unconventional acquisition strategy impact the banking industry? And what does this mean for the future of banking regulations? Portico Capital, a blank check company, has strategically positioned itself to acquire failing U.S. banks, a move that has garnered significant attention within the financial community. With a green light from the Office of the Comptroller of the Currency, Portico Capital is set to navigate around the conventional barriers that prevent private investors from acquiring banks shut down by the FDIC. This bold strategy indicates a wager on the continuation of instability in the banking sector. Portico Capital's entry into the banking acquisition arena prompts questions about its long-term goals and potential repercussions for the industry. By focusing on distressed banks, Portico Capital may instigate a shift in the competitive dynamics, possibly leading to a concentration of influence within the banking sector. The involvement of experienced Wall Street professionals in Portico Capital introduces a layer of complexity to the narrative. Their expertise in the financial domain offers valuable insights into the intricacies of bank failures and acquisitions. Nonetheless, this insider perspective also attracts scrutiny over their motives and the equity of the acquisition process. The FDIC's endorsement of Portico Capital's acquisition plans marks a critical juncture in regulatory practices. The FDIC typically advocates for selling failed banks to other institutions to maintain regulatory control. Thus, the approval of Portico Capital's approach signifies a notable deviation from established norms. The FDIC's response will be instrumental in shaping the trajectory of these acquisitions. Although approvals have been granted, the FDIC is anticipated to closely monitor the developments to protect depositor interests and uphold financial stability. In essence, the cessation of the BTFP and the emergence of Portico Capital reflect broader trends in the banking industry, where regulatory frameworks, market dynamics, and strategic investments intersect. The unfolding events will likely influence the future of banking regulations, the stability of smaller financial institutions, and the role of investment entities in shaping the sector's landscape. As the situation evolves, the industry will watch closely to see how these changes impact the banking ecosystem and the economy at large. The acquisition of failing banks by Portico Capital has the potential to shake up the entire banking landscape. This type of consolidation could streamline the industry, bringing about stronger, more efficient players. But there is also a dark side, the potential for less competition, ultimately hurting consumers with higher fees and fewer options. This begs the question, which will prevail? How will the industry's health be affected in the long term? Regulators will have their work cut out for them as the situation evolves. With Portico Capital now in the mix, they'll need to be hyper-vigilant. It's paramount to ensure that this consolidation doesn't make the entire financial system more vulnerable to crashes. The FDIC and other watchdogs have a crucial task at hand, establishing safeguards that keep the system stable and consumer confidence high. Investors are, naturally, fascinated by this development. They smell opportunity. Failing banks acquired on the cheap could be turned around for huge profits. Of course, the risk is just as real. Acquiring banks that simply can't be renewed would lead to substantial losses for investors. Add an economic downturn to that scenario and the risk grows even greater. It's a balancing act between potential rewards and the harsh realities of the market. Public opinion will also be a major factor. People's trust in banks have been shaky for years, and Portico's Capital has the chance to either rebuild that trust or destroy it. To prevent a backlash, complete transparency about their intentions and operations will be necessary. Vague statements won't cut it. They'll need to be clear and forthcoming to keep the public on their side. After all, a spooked public could pull their deposits and restrict lending, a major problem for the overall economy. What Portico's Capital is doing could completely reshape how we think about banking. This shift could alter the entire landscape of credit and investment, sending ripples throughout the economy. How will they change lending practices? Will small businesses get the support they need, or will larger projects become the focus? Their choices will have a big impact on economic growth potential. Portico's Capital's innovative strategy to acquire failing banks through a shelf charter presents a unique challenge to the established legal framework governing financial acquisitions. By leveraging this method, Portico's Capital circumvents the conventional processes that typically prevent private equity firms from directly purchasing banks shut down by the FDIC. This maneuver not only tests the boundaries of current banking laws, but also sets a precedent that could reshape the landscape of financial ownership and regulatory oversight. The Office of the Comptroller of the Currency has reintroduced the concept of shelf charters to enable private equity and non-bank investors to participate more broadly in resolving failed banks. This mechanism was first introduced during the financial crisis of 2008-11 and allows organizing groups to receive preliminary clearance to establish a new bank solely for participating in FDIC failed bank transactions. The shelf charter is valid for 18 months and can be renewed, providing investors with a streamlined path to engage in the banking sector. The utilization of shelf charter is a strategic move that allows Portico's Capital to act swiftly in acquiring distressed assets. However, this agility comes with heightened scrutiny from regulatory bodies and the financial community at large. The company must navigate a complex web of banking regulations, which are traditionally tailored to conventional financial institutions rather than the innovative models represented by firms like Portico's Capital. To maintain the confidence of regulators and the public, the firm must demonstrate robust risk management protocols, transparent operational practices, and a clear vision for the future of the banks under its control. Portico's Capital's entry into the banking sector as a non-traditional entity could herald a transformative period of innovation and change. And that's it for this video. We hope you enjoyed watching it and learned something new. If you did, please give this video a thumbs up and share it with your friends. Also, don't forget to subscribe to our channel and hit the bell icon to get notified of our future videos. We have more amazing videos coming up, so stay tuned. Thank you for watching, and see you next time.